future. We're talking real money.
855-935-TALK is our phone number, 855-935-8255. I'm Don McDonald, and Tom is over there. We're 3,000 miles apart, and yet together in our hearts and yours. And, what I was going to say is, look at us. Isn't this Memorial Day weekend? When we were putting this together?
I see you're going to start with the breaking your arm, patting yourself on the back part of the program.
That's what I was going to do, because look at us. We're here for you on Memorial Day weekend when the TSA says that pre-Memorial Day weekend, they had more people flying than they have ever.
Yeah.
What does that tell you about America's changing work ethic?
Well, I think they all flew like Wednesday, because I haven't seen anybody since then. So.
Have you noticed that Memorial Day weekend sort of became Memorial Day fortnight?
7 days.
Well, fortnight's like 10 days, isn't it?
Yeah, I always forget the Brits know that one.
I think it's like that now, because I noticed that almost a big chunk of our compliance staff was on vacation. People are saying, I'm taking PTOs on. Really?
We'll see you next Thursday. Yeah. Jump right back into it.
I'm thinking maybe we should just shut everything down the end of May, and we'll be back here. We'll be back with you in September. Thanks for listening. I'm Don. That's Tom, and we're going to take a longer than European style vacation.
Well, I only have 3 more Saturdays after this until I am taking a lengthy trip, as you know, to Africa. So
I know. Oh, and by the way, I'm going to need your help. When do you leave? What's the first Saturday you're not here?
Well, let's see. I'm leaving June 17th, so 5 days after that, I guess.
Hold on, let me look at my
22nd, 23rd, something like that.
June. You're leaving.
I'll say the 22nd is the first day you're on your own. Is that right?
22nd, that is correct.
Yeah. Okay.
I'll be on my own the 27th, 29th, and 6th. Is that correct?
That's right. Yep.
All right, so I need you guys to help me out, because you don't just want to listen to me talk for 2 hours. You're going to.
He could do it, by the way. I've seen it done.
I can.
The sky is blue. Let me tell you why.
Before we even get to our topic, the very first show I ever did on Business Radio Network was in July, by the way, of 1988. July of 1988. I was on overnights.
It's like 5 hours or something.
I was on midnight to 5 I think. Eastern time. And we had, they claimed we had one station carrying our signal. That was the station owned by the guy who owned the network, and his station was in Leadville, Colorado.
Not a huge audience.
I'm thinking 500 or so. At 10,000 feet above sea level, so midnight to 5 a.m., everybody's just passed out from hypoxia. So that night, I literally talked for 5 hours. Do you
remember what you were talking about? Do you have any recollection?
I was talking about elk. I thought I would do a whole show on elk because maybe their antlers were acting as receivers, and they were the only ones listening in. No, do you think I remember? I think we had guests back then. So no, I didn't have a guest even, because nobody would go on.
I was a guest on one of your shows when you're doing it at night.
But
that wasn't
was
that
years
late.
later. That was when we had 90 stations.
That was like 1993 or something.
Yeah, we had
somewhere
90 stations
92.
by then. So we were. But the first show, one station, Leadville. 855-935-TALK is our phone number. When we get back, we talk about investing mistakes.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Now let's get talking real money officially underway. I'm Don. Tom's over there. You're out there. Call us at 855-935-TALK if you have something money-oriented you'd like to talk about. And the thing that we want to talk about today, Tom and I do a lot of reading. And lately, Tom apparently is paying a lot of attention to Christine Benz's articles from Morningstar, because you've had a couple recently.
I have, yeah.
We like Christine. We like her writing. We like the company for which she works. We think Morningstar is a great company. We think they make some mistakes, but we think they're a great company. And Christine wrote an article. She recently wrote an article about focus on things you've done right. You haven't done everything wrong. And this is something Tom's really good at. Focusing on the things you've done right. I'm more about, you did I'm a little more negative. He's a little more positive. It's just the way our brains work.
Probably fair. Yeah, that's good.
Yeah. But Christine is more Tomish. And she said, I look at these portfolios for people and I see what they're doing wrong, but they do more right than wrong. But I see what they're doing wrong. And she claims, and I don't agree with all these, she claims that there are 5 things that you're doing. Well, I don't agree with what she says, I should say. 5 common portfolio building and managing mistakes. Tom.
I see a lot of these on a regular basis.
Yeah,
That's why I like this piece. I see a lot of these, and because one of the really nice parts of my life is I get to meet many of you, and which I totally enjoy. But so let's just touch on these, and we'll see which ones we disagree on here, because it sounds like maybe we're going to.
Well, I'm going to disagree on what she says about them, I think, more than anything. As a matter of fact, the last 2 could have been, it could have been just 4 things, in my opinion. But
all right, we'll let you get to that. She calls this portfolio sprawl.
Oh, it's hodgepodgeitis is the term.
It is total
hodgepodgeitis.
Too many accounts.
Identified. Move on.
Too many holdings and too much redundancy. Every day people come and see me and they have, guess what? Oh, I've got that orphaned 401k. I get a new 401k. Mm-hmm. I have an IRA I opened 25 years ago that's been holding that for 25 years. I have this other IRA that we kind of put money into for a while. I got a Roth there. Oh, yeah, that's right. I got a SEP IRA there because I worked for somebody else for a while.
And I bought some company stock here. Yeah. I don't know where that is right now. Yeah.
And the first thing I tell people is, you can put all the pre-tax 401ks, IRAs, SEP IRAs for that matter, in one individual retirement account, which will be a lot easier to manage.
Right, it simplifies.
Probably your costs will be lower, and you'll know what you own. You won't have too many holdings. You won't have redundancy. But this is the number. Don's the one who came up with the word, which people love. They love hodgepodgeitis. You got to get it on Wiki or something.
No, we need to submit it to the dictionaries. You can actually submit words, but we just call
Paul Merriman, right? Doesn't he have a dictionary, the Merriman Dictionary? No?
Yeah, okay. I think that was Merriam-Webster. Yeah.
Merriam-Webster. Okay, I thought I was closer. Anyway.
Merriam-Webster, we know.
All right, just having a little fun.
Tom's joshing, y'all.
Yeah, I got you. Okay, so that's... And she says it's the biggest issue, and I totally agree. You gotta clean things up. It's just one of those things. And, we're coming into the middle of a year. Maybe you say, I'll do this by the end of the quarter or something. I give myself little mini deadlines all the time. Like, I got to do this before I go to Africa. That's got to be done. Things like that. Because I find I get them done if I do that. But that's a huge one. The second one, and it's a bit, as you said, maybe it's a tad redundant herself. She says, a redundant individual stock portfolio, because people, again, and it won't surprise you if you're listening in the Northwest, a lot of people in the Northwest own Microsoft. They own Amazon, Boeing, Starbucks. Don't those names kind of sound familiar? Oh, that's right, because they're big companies in the Northwest. But then it turns out, because you own the S&P 500, that you own Amazon, Microsoft, Starbucks, Boeing again, and in large portions because they make up a big part of the Standard & Poor's 500.
And this
That's
is one
not a
where
good thing.
I really disagree with her. I think her take should have been, she's saying you need to just get rid of some of the stocks. I think she should have said there is no, if you have, which she talks about, her minimalist portfolios, by the way, one of which is basically VT and a Fidelity Intermediate Bond Fund. So if you already own those, if you own those, then the answer should be you don't need any stocks at all, individual stocks.
And I think if we sat down with her, she'd agree that individuals should not hold individual stocks anyway. Right?
She should have said it in the article.
She didn't say that. But this is a huge problem that people have a tendency to way overlook and underappreciate the danger of that. Because she mentions Apple, Amazon, and Microsoft, which she says take up about 16% of the S&P 500. If you own those 3 stocks as individual stocks too, now your portfolio could be 1/5 in 3 stocks.
More. I mean, because a lot of people have very large positions in these if they've bought them over many years. You could end up with half your portfolio in 2 or 3 stocks.
And that is so dangerous because those companies one day, I think Jeff Bezos even said it recently, one day Amazon will go away. Mm-hmm. I sat there and thought, then I won't get any deliveries at 5 a.m. What am I going to do when the dog doesn't bark at 5 a.m? It's going to be horrible.
What will happen is there'll be a little pad on your desk where you push a button and it appears.
I want one where I just think it and it shows up.
Think about that for a minute. The fact that Amazon is going to go away. It will go away.
Yeah.
The reason Kmart went away
or Sears
was Walmart and companies like that. The reason malls are going away is because of Amazon. There'll be a new idea some day. It could be a very long time from now. Remember, Sears survived for well over 100 years. Still kind of survives today.
Are there any retail
I don't know. I can't find one.
Okay, I wasn't sure. So my son worked in one. Your mom worked for them.
Oh my gosh, my mom was an exec. I worked in appliance repair, and as a stock and sock salesman.
That's right, you were. I forgot that. Stocks and socks.
Stocks and socks.
Level 2. Yeah, that's good. Those two are huge. Here's one that I think also people have a tendency to do. And she says, investors can be too patient and too hands off. They purchased mutual funds and set up their portfolios a number of years ago and apparently never looked at or touched them again. And you end up in some very expensive, poorly operated, actively managed mutual funds that have way underperformed indexes, but I always kind of own that American funds or Janus or whatever it is, and they sort of stay there. That's a problem.
I am guilty of this. There was a time when I actually believed that active management was worth the extra money because smart people should be able to make more money. But when faced with evidence, really compelling evidence and data to the contrary, I changed my tune. Christine should change hers too. And that's where this one, I think, comes up short because she doesn't say, get rid of all of your actively managed funds and just go with passive or index products.
Again, the problem with that, of course, is her employer, Morningstar, gets paid a lot by the people that run the actively managed funds. I get that.
You mean this ad right next to the article that says Alternatives by Franklin Templeton?
Good old Franklin. Speaking of funds that have been around for a long time that you should get rid of. Good
or
Lord.
Explore our active fixed income ETFs, JP Morgan.
Oh, the fun never ends. But that's big. That is a big problem, and you should fix it soon. It's costing you money. We'll talk about how much money in just a minute because this is another thing people forget.
It does cost you a lot of money, and the more you pay, generally speaking, the less you make. 855-935-TALK. Please call us. We'd love to talk to you this holiday weekend.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome back to our Memorial Day weekend show, during which we anticipate few calls, but we've been surprised before.
Oh, yeah, on some holidays it's shocking.
We get a lot of calls.
You just never know.
Hey, if you've always thought, I would like to call Don and Tom or Tom and Don. Most people say Tom and Don for some reason. Why is that?
The reason should be pretty obvious to you, but I'll let you try to decide.
The Don comes first in the alphabet.
Okay, fair enough. Yeah, let me finish this thought.
Wait, I'm not done. Call us at 855-935-TALK. Now it's your turn. Back to the mutual funds.
This is the part that I think people underrate, how much they're paying out. I like to equate it to a gallon of gas because most people still buy gas. I buy mine now every 6 months or something.
I buy gas.
Not often. So I just looked yesterday at my local ARCO station as I was driving by, $4.57 a gallon.
Okay.
$4.57 a gallon.
I've changed my plans. I am not coming out to see you.
You're gonna need to have the tanker follow the KC-135.
Because I get like 8 miles per gallon towing the trailer.
It's not gonna be easy. Okay, but if you're using an old mutual fund, Franklin Templeton, I'll bet you dollars to donuts without even going online and look that their average equity fund probably charges, just for sake of argument, 0.8, just for fun. Probably right. And then at the same time, you can go buy basically the same stocks for 0.15 in an exchange traded funds. Now, by my reckoning, that's 5.3 times more. And so to use the gas equivalent, if you're paying $4.57 and filling up the silver bullet, instead that, if you stick with Franklin Templeton, now you're paying $24.22 a gallon. day after day after day, and you don't see it.
Do you know what
But
I
it just
just saw? I
goes.
went by the gas station right outside my town here this morning, and it was $3.49.
Good Lord. You should really fill up before you leave, I think.
Should.
Maybe,
I should pull a tanker behind the trailer.
Should be.
And by the way, just to your point about the fees, I just looked up one of the more popular funds at Franklin, the Franklin Growth A shares, which is a front-loaded fund. So I'm not I'm not using the 12B1. If I use the B or the C, it would be twice this. 0.8.
Yeah,
you totally
that was just a
nailed
guess.
it.
That was a guess. So again, so when people say, "Well, that's not that much," okay, so you're going to go fill up to $24 a gallon.
Yeah, compared to 0.05 or 0.1.
Well, I say 0.15 because then you get emerging markets, other stuff. But you really should you should at least know. If you can say, look, well, they're just really smart people. Because wasn't it Ben Franklin's name? I mean, I love Ben Franklin. So if it's got to be Ben, happy to pay more for the association, right?
Oh, sure you are. I don't believe you. I want to look at the Franklin Growth C just to see how much higher the fee is.
Let me guess.
I love making this point about the C shares. C shares are the hidden load funds. It's like, oh, no, you don't pay a commission. Yeah,
they probably, what do they got, another 0.4% on there, or 0.3?
Oh, no. Remember, it's 0.5. I mean, 0.8. Right. 0.8 for the A shares with the 5.5% commission, or no commission up front, 1.55.
Oh, I got to rerun my gas thing here. Hang on here. That's good. Time to get the numbers that big. So, yeah, I mean, this is something really, okay. But again, if you believe in that fund, you believe in the manager, then that's fine. But we don't, as you know, because we think the track record shows even if they have been great, they won't be into the future. But you really ought to know. And if you're paying that almost $25 a gallon of gas instead of $4.57, you should really stop, because that's, as I said, expensive and ongoing. It doesn't change. So getting rid of also ran mutual funds, I think that's a good one. Here's another one. I think you said you're going to poo-poo this, but...
Well, I'm going to poo-poo the fact that you didn't combine the next two.
Okay. Because this is huge.
No, I think it's huge.
This is after hodgepodgeitis, this is the one I see the most, frankly. And that is asset allocation not informed by the plan. What does that mean? Well, that means you come in and you tell me, yeah, I want to be, make 6-7% a year. I want to be 60% in stocks. Then we analyze your portfolio and you're 85% in stocks. Mm-hmm. So you're taking way more risk than you either need to or want to. That's a huge problem. I think she's very much correct there. And she wraps it up by saying suboptimal asset location, which is something, again, people have a tendency to forget. Municipal bonds in a tax sheltered, she calls it, I call it tax deferred account. Never want to do that. That should be in a taxable account. I see Roth IRAs with bonds in them. I see bonds in regular taxable accounts. So you're paying, tax on the interest. I see REITs in taxable. I see a lot of things like that just really, you're just paying tax
things
you don't have to pay.
That are where they shouldn't be. And we have one more for you. Then we have some questions. You can call us with your questions, though, and those will take priority at 855-935-TALK as we continue talking real money.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Welcome back to our little program we call Talking Real Money. I'm Don McDonald, Tom Cox over there. We appreciate you being there on this Memorial Day weekend, or a few days after if you're listening to the podcast. 855-935-TALK is our phone number every Saturday, noon to 2 Pacific, 3 to 5 Eastern. And we love taking your calls. We're talking about an article written by Christine Benz at Morningstar. It was about the 5 big portfolio building mistakes, managing mistakes we make. And we've gone through several of them, but there was one more, and that was related to how your portfolio is allocated once you stop accumulating and start needing income.
Yeah, and there should be some differences here, because accumulators, it's a different situation. What you're really hoping for is maximum growth, right? You're not so concerned about stability, hopefully, because you're trying to make that. You don't really need assets you have to draw from, right? Because this isn't money that you're going to start spending. But I would say anytime within 5 years of the day you're going to need this money, that your portfolio should start moving to a few different things. Number one would be, frankly, fixed income.
I thought you were going to say Franklin.
Number one is Franklin.
No. Tom lost it. He officially lost it. Sorry, the show's over
zapped
now.
By Franklin's lightning.
Yeah,
No,
I knew that's where you were going to go.
Yeah, easy. No, I mean, you've got to have some fixed income. And here's why. Because many people still say, well, I want to make as much as I can like everybody else.
No.
That's not really what you're shooting for when you get to retirement. Hopefully it's never what you're shooting for. I mean, there's only one Jeff Bezos. Okay, we all want to make money, but do you really need to make that much? Anyway, not to get too deep into it.
But the other thing is, that's why we talk a lot about risk profile as opposed to risk tolerance. You may go into retirement being able to take a lot of risk comfortably, but why do it if you don't need it?
Yeah, and so one way to reduce that risk is to move some of your money from stocks, which have traditionally made a decent amount, but you've had to take the volatility to less stocks and more fixed income, sort of the
Although,
ballast.
As Christine said in her piece, they haven't made a good case for themselves recently.
No,
fixed income securities.
If you suffer from recency bias, you're not going to own them because they've actually had a pretty stinky 10 years now, because you had that one absolutely horrible 2022 where I think BND, the Vanguard Total Bond, lost 13% of its value. So that's a bad year. You throw that in there with everything else. Not been very pleasant. Yield's been low. They're back a little bit. I just looked, by the way, at the Dimensional Intermediate Term Bond Fund, still down 1.5% year to date. But, okay, that would be one change, right? The other change would be knowing where you're going to take the money from and when you're going to take it. This is another part people just don't think about. Like, well, but I have all this money. Well, okay, how are you going to start drawing from it?
There is a withdrawal order, and
there is. Yep.
And the smart investors gradually move the money over time too, from the riskier assets to that safer immediate needs pool, so that you don't do it all in a bad market, for example, and you feel
you see that happening. Yeah. In 2008, spring of 2020, times when you really didn't want to be doing that, you end up selling low and buying high. We never want to do. I mean, again, so all those things should be about you, not about where the market is. I think that's very good advice, Don. So this is just something that people don't pay close enough attention to.
And to me, the moral of the whole story is what she's essentially saying across all of these 5 things is simplify it. Your portfolios are too complicated. You're overthinking or overdoing or not doing some of the things you should have done, like rebalancing, but simplify.
And cleaning it up. Getting rid of the hodgepodge-itis, getting rid of the expensive, crummy, if you will, actively managed mutual funds that are really hard on returns, right? I mean, you look at the Franklin Fund, it's...
Oh, gosh, really? Can I do this? Can I do this? Franklin Growth C. I want to be fair to the no-load index fund. So Franklin Growth C is a no-front-load fund with an expense ratio of 1.55%. Now, you would think to justify that, they would have to do really, really well, right? They should.
Huge. Yeah.
Their 15-year average annual return is 13.86%. Sounds good. Except you look at the index that Morningstar assigns, which is a large cap growth index. It did 16.4% over that same 15-year period. That is a difference of over 2.5%. By the way, in 2023, they earned 14% less than the index.
Tom and Don are talking real money.
Do you suffer from hodgepodge-itis? I'm Don McDonald, and hodgepodge-itis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodge-itis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
Hello and welcome to the show again. I'm Don, that's Tom. You're there. We hope you'll call us at 855-935-TALK. 855-935-8255. But we also take your questions another way, and we answer them along the way when you send them in at TalkingRealMoney.com on the contact form, which is really, really easy to do. You can speak them there, and then I answer them on Friday's podcast, or you can type them, and then they get answered on various other podcasts, or right on the show, like this right now. Right,
Yeah,
Tom?
a lot of people write these in. They're shy. They don't want to hear their voice on the podcast. They don't want to hear their voice on the radio show. That's fine. And this comes from Brian in Evans, Georgia. He says, Tom and Don, you're often proponents of flexible withdrawal strategies versus fixed.
Yeah.
What are we talking about here? What's the withdrawal strategy? What's that?
Is that what he asked?
No, I'm
want me
throwing
to
that out there
explain
to
it?
try to clean it up so people know what we're talking about.
It's adjusting your income stream in retirement based on how well or poorly your portfolio has performed in a previous period, usually a year. So,
but he's talking about, should you take out a fixed amount of your portfolio?
A flexible amount. You take out a flexible withdrawal strategy says, I am going to take out, for example, 5% per year of my portfolio. That means in some years, as you've said, you go to Hawaii. In other years, you just stay home for your vacation. You do a staycation.
Okay, fair enough. You
like
wait
that.
for Don to show up in the lot there and warm your summer with that. Okay, but he says recently Paul Merriman's team did a podcast, and this is Paul, that demonstrated multiple variable withdrawal percentages, 4%, 5%, or 6% over 50 years. Found it interesting that no matter whether you subscribe to an S&P or to fund for life equity investment, in a classic 60-40 split, you ended up being able to both spend and leave more legacy over that 50-year period when you stuck to and here's the part where it gets a little confusing. Like that wasn't confusing enough. When you stuck to the 4% withdrawal of total asset value in any given year, no accounting for inflation.
That's right, no accounting for inflation. The flexible
that is right.
withdrawal
Okay.
strategy has no accounting for inflation.
No, he's talking about 4% annual withdrawal with no accounting for. I think he's confused because generally when we run the 4, we say you got to adjust for inflation.
4 adjusted for inflation, or we usually run 5, but we could run 4 or 6.
Correct.
Not adjusted for inflation.
Exactly. Then he also adds in, if you add international, you did better. But he's really asking us, would love to know what you think about the team's analysis, accepting that the past doesn't look like the future. Here's the thing. And speaking of Christine Benz, I think this is her quote. The only correct withdrawal rate you'll know is after you're gone.
Right.
You won't know for sure. Number 2, Don's has, and you've said this for years, and you're right. If you're flexible, the money should last longer because sometimes the market's down, you can't get as much. Sometimes the market up, you can take more. Most people don't want to live that way, but they probably should.
Yeah, well, here's the thing. And this really is the crux of the matter. Have we ever seen an environment in which you would not have made 4 or 5% per year on invested capital, even in bonds, really? Even if it was like almost
with
100%.
A balance between stock. 100%
even
bonds?
almost 100% bonds. It's 4 something over 100 years.
Yeah, but there are periods of time where if you just put it all in bonds, that
you would have run out of money. Right. But that's what I'm
Yep.
saying. Worst case scenarios. If we hit the worst of the worst of the worst case scenarios, which is like what I think a lot of people are alluding to. Well, yeah, but next time it's just going to be a total collapse of Western society. Then who cares?
It's not going to. Your withdrawal rate's not going to be something you're worried about.
Why are you going to care? You are really, truly going to care where your next meal's coming from. So for all you folks who believe that everything is going to hell in a handbasket, I could not. The best advice I can give you is Costco.
Buy that. Don't they have that 2,000 meal thing or whatever? Anyway,
Yeah.
Okay, but let's go back to Brian's question because I think
don't know what his
important
question
one.
is.
Well, his question is kind of, what do you think of all this? Here's what I think. You just mentioned this with our friend at Morningstar, Christine Benz. How about simplicity? 4, 5, 6, adding this and that. It's a lot, right? I mean, you build the right portfolio for what you said, ability to take risk, how much risk you need to take. I think, stay flexible, and you could stay flexible with 5% if you have a decent amount of stocks in there. You do this, and again, you have a flexible life, which allows you to sometimes take more and sometimes take less. That could happen.
And if you don't,
it should work.
if flexibility doesn't work for you, and that's not a dig on anyone, sometimes we just don't like the idea of having less. Then, and this is an area where we get into trouble sometimes. Everybody says we hate all annuities. That is not true. We hate most of the complex, highly sold annuities like index annuities and variable annuities and those kinds of things. But when it comes to an immediate annuity, there is a place for some people with an immediate annuity because what it does, it's not the best deal financially, probably, but it gives you absolute. No, don't use the word absolute.
Can't say absolute.
Gives you a reasonably high level of certainty that you're going to get your paychecks because and you give your money to the insurance company. You
got to give it to the insurance company. You got to accept what you just said, that financially it might not be the best deal, but it also puts people on a budget. Like, here's how much you're getting.
Right. And it's
right.
It's rarely, unless you take a smaller payment initially, it's not going to be adjusted for inflation.
Exactly.
And the thing about either the flexible or the 4% rule, which is 4% plus inflation, is that both of those tend to adjust for inflation. Because remember, stock portfolios, businesses, when there is inflation, they raise their prices, their earnings rise, their value increases.
Shockingly enough.
So there is an inflation component in equities.
So there's, again, back to Brian's question.
It's a trade-off.
It's a trade-off. Do I think you'll be okay somewhere in the middle here with both the stock-to-bond ratio and the withdrawal rate? Yes. Do I think most people, by the way, need to sit down with a professional and say, here's what I'm trying to do. What do you think? Will it work? Most people.
Will you hold my hand when it doesn't for a little while?
Yeah, because it won't. I can almost guarantee
it. You're going to go, no, I went from $80,000 to $60,000. I can't do it.
Right. And you need someone there saying that was part of the plan. Stay on the road. You're going to be okay. But Paul, God bless him, who I love, as you know, this is overthinking.
Paul's an overthinker.
The numbers. He is.
Because he's a numbers guy.
He's an engineer.
Yeah.
He is. He loves it. I mean, he'll sit around all day and noodle on this stuff. Do I think you need to know it all? No. Do I think you could be in the middle somewhere? Yes. But do I think you need a professional to review it? Absolutely. You do.
You do.
So it's a great question, Brian. And the answer is kind of.
Yeah. What is the, this is the standard answer to almost every financial question. It depends.
Yeah, it really does.
It depends. Because almost every question relates to what will happen in the future.
Well, and I'll tell you another thing that works in your favor is what you and I are doing. We're not going to start drawing our money till about 70. I mean, maybe even later.
No,
so
probably.
The odds then become much better because if we only live till 80, that's a pretty short period of time to draw your money down.
Yeah, given the fact that in a few weeks I'm going to be 68, 70.
Well, yeah, and by the way, but we want the show to continue, but we need you to call because if you don't call, then the show doesn't continue, and then we sit at home we just sit here and yammer on.
Are you kidding?
Okay.
You're going to be gone for 3 weeks while I'm yammering all by myself. 855-935-TALK. Call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We know.
And look at that. Boom. Just like that. People called us at 855-935-TALK. Wade, welcome to the program. Hey, Wade.
Waiter?
Oh, hi, thanks. Yeah, can you hear me?
Yep, sir. Yes, sir, absolutely.
Okay, awesome. Let's see. Well, I was going to call with one question, but all this talk about those American funds got me changed my focus a little bit. So, let's see. 20 years ago, I bought the American funds with some Roth money, and I think I have the Class A, so I always assumed it was just sitting there and not being charged, but is that a false assumption?
That is a false assumption.
Yeah,
but
and let's just clear that up.
Yeah.
There's two parts to the mutual funds. American funds has commissions and then the operating expense that they're charging you
do you know
every
which fund
single
you
day.
have while Tom explains? Which fund? Do you know which fund it is?
I don't. I'm sorry. I'm away from all my paperwork.
That's all right.
But,
Fund of America.
I just remember, yeah, there were like four of them, and I just remember American Fund, blah, blah, blah. But I seem to remember something about a no-load, but if it sat there long enough, it wouldn't have annual fees. So I assume
No, that's a good one. Guess what you have? Now we know.
Okay, now I know what you have. That you have the big lie funds, and you have.
Really?
Yeah, those are the big lie funds. We used to call them. Oh God, what did we call them? We called them liar load funds. In fact, the chairman of the Securities and Exchange Commission called them a sales load in drag fund. I'll give you an example. This is one of the lower priced American Fund Class C shares that does not have a front commission. But its annual expense ratio is 1.32% per year.
So while you may not have paid an upfront commission, you're paying this just like I talked about the gallon of gas over it, which in this case actually is you could pay, instead of paying the $4.57, you're paying about $40 a gallon instead of the $4.57.
And just for comparison's sake, so you have a point of reference. The Vanguard Balanced Index Fund is 0.0% per year. So you're paying 1.3% more per year than for basically the same portfolio.
You said 0.0 something.
0.07. 0.07.
Yeah. And you're paying 1 point whatever. Yeah, this is something you wouldn't know. You have to read the fine print to know that, yes, there is a continuing expense here. And in this case, they're lumping something else on it to pay the guy that sold it to you.
Now, are you still working with them?
Yeah. So I guess my question is it should I be able to see that in my statements?
No.
Would I be able to see that, or is it kind of hidden?
One of the great things from this industry is no.
You don't see it because it's in the return. And let me just give you a fascinating example with that. I mean, you generally will make, I can tell you in almost every case, you generally will make about the expense ratio less per year than you would in just an index.
Okay. So if it's a Class A, would it be different?
If it's a Class A, yeah. If it was a Class A share, then the expense ratio, let's see.
0.8 probably.
Probably about 0.8, 0.7,
Yeah.
0.8, yes. So it'll be less expensive,
30.
but it's still going to be 10 times more expensive likely than an index fund because you're paying for a bunch of managers who history shows do nothing for you. Nothing. They turn the stocks over. You're not making more money. So if I had those, particularly in a tax advantaged account, I'd get them out and I'd get them into index funds almost right away. Thanks for being there. Go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?